Kenya's Finance Bill 2026 has landed quietly, but its effect will be anything but quiet. If you earn a salary, run a business, carry a smartphone, or have ever bought crypto, this bill touches you. Today we're going to decode it, not the legal language, but what it actually means for your wallet, your business, and your digital life. Let's go. The Finance Bill 2026 has three personalities. The first is what we are calling the digital squeeze, an aggressive expansion of taxation into the digital economy. Card swipes, crypto trades, software platforms, all newly in scope. The second is everyday trade-offs. Some things get more expensive, but there are targeted reliefs if you know where to look. And the third is KRA's expanding rulebook, a major shift in enforcement power that we'll come back to. Because frankly, it is the most important thing in this bill that nobody's talking about. And there's the missing piece. Pay as you earn. The bill is completely silent on income tax bands. We'll get to why that matters. You tap your card, you think you are paying the merchant, but under this bill, there's a new stop on that journey. A withholding tax checkpoint. Card networks and acquiring banks are now subject to withholding tax. That covers interchange fees, what the card network charges, and merchant service fees. What your bank charges the business. Here is a challenge. These fees are normally settled automatically net in milliseconds. There is no natural moment to withhold. So the compliance complexity is huge. And when compliance is complex, the costs get passed on. Expect digital payments to get more expensive, not dramatically, not immediately, but the direction of travel is clear. This one is for businesses, but its effects will ripple to consumers. Digital payments and processing services are moving from VAT exempt to standard rated at 16%. That's the base layer. Above it, payment networks and processors. Same story. And at the top, software platforms and distribution. If you pay a regular subscription for software delivered via distributor, that's now cut 2. The bottom line, building tech using software and processing digital payments just got 16% more expensive. That's not a rounding error. For a fintech startup or a middle-sized e-commerce company, this could be a meaningful margin hit. Crypto comes out of the shadows. Kenya has one of the highest cryptocurrency adoption rates in Africa, and for years that sector has operated in a kind of fiscal gray zone. People trading, people earning, very little of it showing up in tax returns. The Finance Bill 2026 ends that era. Virtual asset service providers, exchanges, platform, wallet providers must now file annual information returns on every single user, and Kenya can now enter automatic exchange agreements with other countries to share crypto transaction data internationally. The takeaway is simple. The era of anonymity is over. If you're trading crypto in Kenya, assume KRA knows about it. File accordingly. The consumer balance sheet. Now, it's not all bad news. The bill has a genuine give and take structure for consumers. Just need to know which side you're on. On the costly side, housing construction material shifts from exempt to 16% VAT, which means affordable housing just got less affordable. Sugary juices pick up a 20 shillings per litre excise duty, and plastic manufacturers get the 10% excise extended to local production, not just imports. On the relief side, the duty-free luggage allowance for travelers jumps massively from $300 to $2,000. Second-hand clothes mitumba sold locally are now VAT exempt, and the excise on extra neutral alcohol, the raw material for spirits, plummets from Kenya shillings 500 to 80 per litre, which should make local spirits cheaper. Now the smartphone squeeze. The one deserved its own moment. The excise duty on smartphone jumps from 10% to 25% on a 50,000 shilling phone. That's 7,500 more tax overnight. And this isn't just about premium devices. It applies to all smartphones. It triggers at activation, and it removes any distinction between imported and locally purchased handset. Think about what that means in a country trying to drive digital inclusion. The government is simultaneously taxing the infrastructure of digital payments, which require smartphones, while making smartphones 15 percentage points more expensive. Those two policies are pulling in opposite directions. Employee benefits, give and take. Two changes affect employees directly. First, the gratuity restriction. Previously, gratuity paid into a pension scheme got broad tax exemption regardless of how long you worked. Now, that exemption only applies if you have been on a continuous contract for at least 3 years. Short-term workers, contract workers, gig economy workers, they lose this protection. It's structurally regressive. The less secure your job, the more your retirement lump sums gets taxed. On the positive side, if you have a CBK housing loan, you can now claim a mortgage interest deduction of up to $360,000 per year. The same relief commercial bank borrowers have always enjoyed. A long overdue equalization. Bringing the shadows into the net. Two informal sectors get formalized. Sport betting, a 20% withholding tax on winnings, defined as your payout minus your stake. That's technically fair. You are taxed on your net gain, not on your gross receipt. But operationally, it requires betting operators to split stakes from winnings in real time at the point of payout for every transaction. That's a major system overhaul. Scrap metal, a 1.5% withholding tax on all sales for residents and non-residents. Buyers become KRA's collection agents. This is elegance. Instead of trying to tax a diffuse informal seller base, you put the obligation on the more formal buyer. The era of pre-populated return. This is a fundamental change to how Kenyan tax filing works. The old model, you gather your data, you calculate your liability, you submit to KRA. The new model, KRA gathers data from e-teams, from withholding agents, from third-party providers, aggregates it and sends you a pre-populated return. You verify and accept. Sounds great. Here is the danger zone. You are still legally responsible for the accuracy of that return. If KRA's third-party data is wrong and you click submit without reviewing it, the penalty is yours. Pre-population is a tool, not a guarantee. Review everything before you accept. The taxman's expanding arsenal. KRA is significantly getting more powerful in this bill in two ways that businesses especially need to understand. First, originating assessment. KRA no longer needs to wait for your return. You can raise an assessment based entirely on third-party data or inspections, combined with both new anti-avoidance powers that let them recharacterize any transaction they deem to confer a tax benefit. That's a very wide net. Second, and most critically, agency notices. KRA can now freeze your bank account to collect a disputed tax even if you have an active appeal at the Tax Appeals Tribunal. Previously, an appeal gave you some breathing room. That breathing room is gone. For businesses, this is a liquidity risk, not just a legal risk. Accelerated timelines. 2 deadlines changes you must know. Nil returns, whether you are an individual or a company, now you need to be filled within 1 month of the year end. That's down from 6 months. Non-resident shipping companies need to pay their 2.5% income tax within 5 days of payment of the shipping leaving port, down from the 20th of the following month. 5 days. The message is clear. KRA wants money faster. The silver lining, the tax amnesty. Here is good news. The tax amnesty framework has been extended and it is generous. If you have principal tax debt accrued up to 31st December 2025 and you pay the principal before 31st 2026, December 2026, all interest and penalties are waived. That could mean wiping out years of accumulated penalties in one settlement. If you have ongoing audits, cash flow issues, or historical arrears, this is your exit ramp. Use it. The final balance. So how do we weigh the Finance Bill 2026? On the positive side, more administrative convenience through pre-populated returns, targeted protection for local traders and second-hand clothing market, and genuine debt forgiveness through the amnesty. On the negative side, less privacy. KRA now cracks your digital, crypto, and financial footprint at a granular level. Higher tech cost. The 25% smartphone excise and 16% digital VAT are barriers to inclusion. And draconian enforcement, the power to freeze accounts during active disputes, is a fundamental shift in the taxpayer-authority relationship. This is a bill that requires revenue from the digital economy while expanding state power over financial flows. Whether that trade-off is worth it, that's a conversation Kenya needs to have. Everything we have discussed is effective July 1, 2026. Here is your checklist. For individuals, recalculate your tech budget. Phones and subscriptions cost more. File nil returns within 1 month. If you have a CBK housing loan, claim your mortgage deduction and sort out your crypto reporting. For business owners, audit your card payment system for withholding tax compliance. Build a cash buffer against the agency notice risk. Apply for amnesty if you have pre-2025 debt. Review software contracts for VAT implications, and if you are betting or scrap metal, your systems need to be ready for July 1, no grace period. The Finance Bill 2026 is complex, but forewarned is forearmed. That's all for today. Share this with anyone who needs to understand what's coming. And if this was useful, subscribe. We'll be covering the implementation as it unfolds. See you next time.